In terms of owner-occupied real estate, that's probably more applicable to many of you in the room. Typically, banks will lend up to 80% of the value or the project cost, which means you'd be putting in 20% of cash equity into the project. There are scenarios where a bank will consider taking cash collateral, marketable security collateral, or you posting another property that's free and clear as your 20% equity. You probably prefer to see the 20% in cash going into it, but those are some things to think about. If you're looking to buy a building and you're moving, ask a bank for an interest-only period as you get started out of the gates. You're going to have some one-time costs, some moving costs. Ask them to put in a 3-month, 6-month interest-only period just so you can get into the building, absorb some of that cash flow. We talked about the term of these loans. Most of them, if you're talking about investment real estate, it's usually tied to the lease. With owner-occupied, you can find a bank to commit to 20 years, maybe even to 25 years. That's if the operating company guarantees the mortgage and they sign a long-term lease. So you can find long-term commitments for owner-occupied real estate. In terms of fixed-rate options, as David said, 5- and 7-year rates are common bank rates. 10-year rates, there are banks offering 10-year rates. Some banks would prefer to offer them through swaps. I don't want to spend a whole lot of time on swaps. Essentially, let's say you want a 6% 10-year rate. The bank says, I can't go 10 years, but I'll give you a floating rate. I'll give you a prime at 3.25. Some investor somewhere says, I'll give you the 6% rate. So you pay the bank 3.25, you pay the investor the additional 2.75. You're paying a total of 6%, but it's just coming from two different parties. It's a little bit complicated. There's different regulations around swaps. Some people qualify, some people don't. But it is an option to consider if you want a long-term fixed rate. The most important thing about fixed rates is to make sure you understand the prepayment penalties and the unwind fees. Can't tell you how many borrowers we sit down and talk with, and they say, no, I don't have a prepayment penalty on that loan. I can refinance it now. Okay, great. Let's you mind sending me the document just to make sure that you don't have a penalty, so we can help you work through that. And you get it, and sure enough, there's a prepayment penalty in there. And sometimes the calculation, you're a CPA. I'm not sure anybody can really calculate that prepayment penalty. It's an economic calculation with all kinds of things that go into the equation. It's almost impossible to understand. But just make sure you're aware of it, just so there's no surprises and you understand what you're getting into. Another option is consider fixing a portion and floating a portion. A lot of borrowers bought a building 3 years ago, floated the entire thing, several $million bucks, and they're loving it. They're loving the floating rates. They're going to stay low for a little while longer. You can always lock in down the road. So consider maybe floating or fix a piece and float a piece.